Good morning, everyone. Hope you're all doing well. Okay, so today in this workshop, we're going to continue with the taxable income. So on Monday session, we focused on gross income as well as the exemptions. And today we're going to discuss the deductions, which is your allowable deductions based on your general deduction formula, any specific deductions which is allowed in terms of Section 11 as well as 22, and then any deductions that are prohibited in terms of Section 23. And then we're also going to look at the capital allowances, which focus more on your buildings and your type of assets which are of a capital nature, which would have fell out of Section 11A scope. So what I want you guys to do, if you've got any questions, just type your question in the chat function or raise your hand, and then you can just switch on your mic. If I'm going too fast, please just let me know, and then I'll repeat whatever you missed or just re-clarify it. And then we're going to go through the theory in the first session, and then in the second session, we're going to do a practical example to show you how the theory will be asked in a test or an exam. Okay, so let's quickly see what we're going to focus on today specifically is your general deductions, which is Section 11A, and then we're going to focus on the capital allowances after that. So if we just start with the tax framework, this is your starting point when you have to do a physical taxable income calculation. We are currently in that area where I've highlighted, which is your deductions and your capital allowances. So normally you do the general deductions as well as specific deductions first, and then you only do the capital allowances. And you generally do them in number order, but for your purposes, most of the questions, you can just slot them in as you read the information. The only one which you need to do last is the donations amount that you pay, because of the fact that it is based on the subtotal of all the income and expenses just prior to that amount, which you would see here at the bottom. Okay, so let's start with the introduction to deduction. So normally what the Act says is you have to actually be carrying on a trade. So that's one of the prerequisites for a company or business to be able to get a deduction. Now, pre-trade expenses is out of the scope of this module, but that is just Section 11A, which says that if you've already carried on certain expenditure before you even started trading your business, you are sometimes allowed to deduct those if it was to form your business and to get your business up and running, and it would produce income in the future. Now, where you guys specifically have to focus on information is the general deduction formula, which is split up into two tests. We call the first one the positive test, which is Section 11A, which is, can I actually... Okay, so you're asking when the textbook are we? So the general deductions are discussed in Chapter 3 in the textbook. Let me just quickly get the page number for you. Okay, so general deductions is Section 3.5 in the textbook. This slide is not in the textbook. This is a summary of a lot of information together. So we are going to discuss the points in the textbook as well. This is just a summary to explain the background. But if you page your textbooks on page 164, this is where the general deductions is discussed. Okay, so the first test we call the positive test. That's Section 11A. That's your general deduction formula. Now, there's 5 requirements, which we will discuss shortly, which needs to be met before you are allowed to deduct an expense as a general deduction or allowable deduction in your income tax return. Now, Section 23 is items that are specifically prohibited. So something might meet the definition in terms of Section 11A, but then SARS actually made a list of specific things that are prohibited to be deducted. So for a test, what they will do is they will ask you if something is allowed to be deducted in terms of the general deduction formula. You would then apply those 5 requirements, but you also need to go look at that list that is prohibited to see if that item is not potentially one of those items that SARS specifically said, no, you're not allowed to deduct, because then your answer would be no, it's not allowed. Now, the negative test, which is section 23G, says that if it's not for an expense for your trade, then you are not allowed to deduct it. Okay, so that falls under section 23 as well. And then the special deductions are generally those deductions which are a bit more capital in nature, which SARS specifically said, okay, these ones you generally deduct first if they do not meet the general definition formula. If you cannot get a deduction in terms of a special deduction, then you go back to the general deduction formula to see if you could potentially still get the deduction in terms of that section. Okay, but as we discuss the different sections, this will make a bit more sense. Okay, now this is just a summary to help you. Can I deduct it, yes or no? So the first question you have to ask yourself, is this amount specifically disallowed in terms of section 23, which is the prohibited items? If your answer is no, then you deduct it in terms of another session. So that is your special deductions. If you can't deduct it in terms of one of those sections, then you go back to section 11A, which is your general deduction formula. If something is specifically disallowed in terms of section 23, there is no deduction that you are allowed to make. Okay, so that's just the general rules that you need to be aware of. Now, why do we have section 23B? It says you can only deduct something once. You're not allowed to deduct it multiple times under multiple sections. So normally what happens, you first start with the specific deductions, and if it does not fall under one of those, then you go to section 11A for that deduction. Now, we're going to start with your general deduction in terms of your deduction formula. Now, these items is what are discussed in your textbooks starting on page 164 up to let's quickly see, 168. Okay, so in chapter 3. So the requirements for you to be able to deduct something in terms of section 11A is you need to be carrying on a trade. Now, your textbook does clarify what a trade is, so we're going to look at that as well shortly. So what is included in a trade, what is specifically excluded, then you need to have incurred expenditure or loss. And then actually incurred, so you are liable to actually pay it. There's not a condition that is still needs to be met. You've actually incurred it, or there is a precedent that you have to pay it. Now, the year of assessment is your tax year of assessment. So what they would sometimes do in a question is they would give you information that falls over these year of assessments to test if you know in which year you're supposed to place it. Now, generally, with expenses, it's in the year that you've actually incurred it. It doesn't mean when you've actually paid it. It just means you are obligated to pay that amount in that period, or you have already paid it, whichever is the first. It is in the production of income. Now, that is generally where the difficult part comes in to motivate whether it's in the production of income, because there are a few case law that says that certain risk, even though it is associated with a business, if you were negligent, you will not be able to claim the deduction, as that would not be seen as part of the production of income. And then the last one is not of a capital nature, similar to the gross income situation, but not exactly the same. So this is just making sure that the amount we are paying does not create an enduring benefit, so a long-term benefit. So if it's long-term, it would be capital. If it's short-term, it's generally more of a revenue nature. Okay, now let's look at each of these areas specifically. If we look at carrying on a trade, now carrying on a trade includes any profession, any trade, any business, employment, occupation, letting of property. So you can see when we talk about trade, that definition is quite broad. So it generally includes everything except the following items. So it excludes something that we call passive income. So that's your interest and dividends that you earn, like on investments. That is money that you put into an account and you just make it sit there and it earns money for you. So that is what we call passive income. You don't actively manage that account or investment to actually yield interest and dividends. It also excludes hobbies. So if you do something purely out of a hobby, it is not considered as a trade. You must have active continuity of the activity. So that means these activities occur on a regular basis. You do it over multiple periods of time. It's not a once-off that you are doing, because that would also not be considered a trade. It would be more likely a hobby. Okay, as a taxpayer, you are allowed to have several trades. So when you generally do your tax return, you would go and split up all the different trades that you have, and then you would do this calculation, your income and expenses for each and every one of them. Now, in your scenario, in your test, you would just document all the income, all the expenses. You would not go split them separately. Okay. Another thing is there is an expectation that a business makes a profit. It doesn't mean that the business have to make a profit. So you've created that business to actually make a profit. The fact that you're making a loss is fine, because depending on your business and the economy, and there's a lot of other factors, you can actually run a loss during the year and you are allowed to deduct the expenses. So the court case that links with this one that says there is an expectation to make a profit, or despite the lack of profit, it must be exclusively used for the trade, is the De Beers holding court case. Now you need to know the court cases, because when they ask you theoretical questions, you need to list these court cases to get marks. And then section 23G, the negative test, which we talked about, states that a taxpayer may not deduct an amount that was not extended for the purpose of trade. So that is generally an expense that is more for private expenditure, or for things like bribes or penalties and things like that. Okay, so this carry on a trade applies to all your specific sections in section 11 and not just section 11A. So it applies to all of the section 11 deductions. Then expenditure or losses. Now the Act caters for a company where they pay expenditure, which is a voluntary expense, or they make a loss, which is involuntary. That is how business works. You can't always manage what you're going to pay. It also includes liabilities that will be settled at a later stage. So let's say you get sued by another company, you have a liability to pay that amount in the future, but you have not paid it as yet. You can still get the deduction because it was actually incurred. Okay, so when we look at this, it doesn't always focus on just the outflow of cash. It can also be outflow of services, similar to your gross income. And then the Jaffe case actually says there's a very little distinction between what is an expense and what is a loss in terms of the Act. So they've left it quite vague to give a business the opportunity to actually claim these expenses if it was in the production of income and for their trade. Then actually incurred, like we said, not actually paid, I've incurred it. So I have an obligation to pay that amount, or I have already paid it. There is, however, a specific rule, section 23H, which is prepayment. So if I've paid an amount that is prepaid for a future period, then I need to go look at the prepayment section to see if I'm allowed to deduct that amount in the current year of assessment, or if I have to defer that deduction to the following year. We will discuss those rules shortly. Okay, another thing is you have an unconditional liability to pay that amount, and that is according to the Nationale Pers BP case. However, I'm not allowed to deduct any future expenses. So if I create a provisional contingent liability, so something still needs to happen before I am liable to make that payment. That is according to the Edgar Storrs court case. I will not include that deduction until that court case or that condition have been met. And if I've got an amount that I don't know what the exact amount is, I have to estimate it if I don't have an exact amount at that stage. Okay, and then the Celtics Oil says that incurred does not mean paid. It is when you have that liability. And then Golden Dime says if there's any legal disputes at that instance, you will only actually incur it once that dispute has been, the outcome has been determined. So once the dispute has been finalized, then you would only incur that amount. Years of assessment, that is your tax year of assessment. So for juristic persons, that's your companies, your CCs, your trusts, they can choose their year end. Whereas individuals and partners and partnerships, as well as micro businesses, their year end is the last day of February. Okay, remember, you can only claim expenditure that was actually incurred. And if you have not claimed it in the current tax year, so you forgot about that amount, you are not allowed to claim it in the following tax year unless it is a prepaid expense, which have their specific rules. With the production of income, expenses needs to be incurred to produce the income. Now, what that means is income, if we go back to, let me quickly flip back to the original. Okay, so if we look at the tax framework, if we talk about production of income, we are talking about this line item. So that is the gross income after the exemptions. So if this amount here is 0, that means we have not actually produced any income. And then you will not be allowed to deduct that expense. If there is an amount on that line item, then you would only be allowed to deduct that expense. Now, if we look at the Port Elizabeth Tramway court case, they said that expense is inevitable, concomitant, or closely connected to your business. So it is an expense that you have to incur in order to run your business. Okay, so it is unavoidable. You cannot get past it. Expenses from negligence, however, cannot be treated as an unavoidable expense because you could have avoided the negligence in the first place, and that is part of the Jaffe and Co. court case, and that will not be allowed. Okay, and then expenses which relates to income that would be earned in the future will be allowed to be deducted because it is in the production of income, and that is according to the Sub-Nigel court case. And then the last one is fines and bribes are not allowed. The court case is ITC 1490, but it's also one of the items that are specifically disallowed in terms of Section 23. When we talk about capital nature, it's not exactly the same as your gross income principle, where we say that something is capital in nature. So what we have to do here is you have to look at the true nature of the transaction when it comes to expense. Now, some of the questions that you have to ask yourself to determine if an expense is capital nature or revenue nature is, does this expense or this asset create an advantage with an enduring benefit? Now, when we talk about an enduring benefit, it is a long-term benefit. It's something that you're going to use for longer than the period of 12 months. Now, if it's short term, we classify it as revenue, and then it's a general expense, you can deduct it. If it's an enduring benefit, so I'm going to use it for a long period of time, then it is viewed as capital of nature. And then that item would fall under your capital allowances, and you have to see if you can get a deduction in terms of those sections. So then you will not get a deduction in terms of Section 11A, but you then go look at the capital allowance sections if there's potentially a deduction that you can get there for wear and tear or something similar to that. You also have to determine how frequent is the asset converted to cash. So that talks about trading stock. So trading stock is something that I convert on a regular basis to cash. So that is something that is revenue in nature. Whereas a building, which I hold to use and then sell on an ad hoc basis, is not a regular asset that is converted to cash. So that would be capital in nature again. And that is according to your new states area case law. And then capital expenditure is generally seen as a once-off or a regular expense, while your income expenditure is a recurring expense. That is sort of how you distinguish between that according to your Flambrosa Rubber Company court case. And then you also have to look at the nature of the business of a taxpayer. So in one business, it might be an expense. In the other business, it might be more capital nature. So you have to look at, based on the business, would that be seen as expenditure or loss in their normal business that they're running? Now let's do an illustrative example to just show you how to apply each of these components when you get a question. Okay, so in this question we say Gas US Limited is a retailer specializing in the sale and distribution of gas bottles used in the residential heaters and grills. The year of assessment ends on 31st of December. It has always taken care to source all of its gas bottles from reputable suppliers that meet industry quality requirements. On the 8th of October, it sells a gas bottle to the Anderson family for use in their home. On the 15th of October, the gas bottle explodes and burns down the Anderson's family home. The Anderson family sues the gas company, and the court rules on the 30th of November that Gas US Limited should pay damages of $100,000 to the Anderson family, and the company settles the amount on the 5th of January 2022. Okay, now if we talk about the required, they want to know if the expense will be deductible under the general deduction formula, so section 11A, for the 2021 year of assessment. Now, because their year end is 31st of December, the 2021 year of assessment would run from 1 January 2021 up to 31st of December 2021. Now, you can see from the information, most of it happened in the 2021 period, except for the settlement happened on the 5th of January, which is after our tax period end. Now, if we look at the different items, if we start off with the carrying on trade, so that's the first component we have to look at. We can state that Gas Limited is carrying on a trade because they're actively carrying on a business in the retail industry and they're selling and distributing gas bottles. So that is specifically what they're doing. Then an expense or loss. Yes, they've incurred an expense because they paid that $100,000 in compensation for the damages with the Anderson family house that burned down. So that would actually be an outflow in the cash. Now the question is, has it actually been incurred? Now if we look at this illustrative example, they've sold the gas bottle on the 8th of October already. The sale itself does not actually result in the compensation becoming liable. We need to look at what actually triggered the liability. So if we quickly go back, we can see here that they said what triggered the liability is they sued us and then for the $100,000 and the company settled that amount. But the court already ruled on the fact that they sued us on the 30th of November. So the fact that they sued us and there was an explosion, that is what triggered this liability. So because of the fact that that court case was still dependent on the 15th of October, we have to look at when did they actually reach the conclusion of whether we will be liable in terms of the Golden Dumps court case. So that was only on the 30th of November when the court decided, no, the company is liable to pay this amount to the Andersons. So we actually incurred it on the date that the court decided that we are liable for it, which is the 30th of November, and not when we actually paid it in January. Okay, so that means our year of assessment it would actually fall in the year of assessment because we've actually incurred it on 30th November, which is still before the 31st of December, and not in the year that we paid it in 2020-22 year of assessment. Now, when we talk about the production of income, we've actually sold this gas bottle. We've generated revenue as part of our nature, so our business. So we've actually produced income from this sale. And then the question is this actually capital in nature? So the amount we paid does not create an enduring benefit. So it does not create a long-term benefit for our business. It's a once and for all expense. If we look at the nature of the business, yes, we do have a risk that there might be defective amounts or products due to the nature of our business. So for that reason, it is not seen as capital in nature. And then the conclusion is, because we've looked at all of these components, it does actually meet all the requirements, so we are allowed to deduct that expense that we've incurred for the compensation of damages. Okay, so this is how you would actually answer the question or a similar question if you get it in a test or exam. Now, if we look at specific deductions, this is not everything else in section 11 as well as section 22. So the first specific deduction that you need to be aware of is trading stock. Now, trading stock is anything that you hold for resale purposes for profit. Now, you have to look at the type of business to determine if it is trading stock. So cars for a motor dealership would, for example, be trading stock. If you have buildings for a property dealer, would be trading stock, groceries for supermarket, etc. So those are a few examples. Now, how do I actually calculate it for tax purposes? Firstly, in the gross income, you would document the sale that you've made. Okay, then under the allowable deduction section, you would deduct the opening stock, you would deduct the purchases, and that includes any cost that you've also incurred in getting that trading stock to location and condition that it is required to be in. So that would include transportation, any importation cost, any assembly cost that you need to incur. And then you would add back the closing stock to your calculation to work out what is the deduction in your tax calculation for the year. Now, if you think accounting, it's exactly the opposite in accounting. So in accounting, you would have added the opening stock, added the purchases, and deducted the closing stock. So just remember, for tax purposes, we just do it the opposite way. Still do the same calculation, but we have to deduct the amount that we have actually incurred. Now, if you dispose of trading stock other than a normal trading instances, you recoup it at cost if someone is going to take it for their own private use. So because normally when an owner takes something for their private use and take it out of the business, we would take it out at the cost. If I donate it to someone or distribute it to the shareholders, or I'm no longer using it for the purpose of the ordinary course of business, or I'm no longer holding it as trading stock, then SARS assume we have sold it at market value. Okay, except for PBOs, which are registered PBOs, the assumption is it would have been at cost. Now let's look at some of the specific deductions which you can find. So when you get to the specific deductions, these things you need to study them and you need to know the rules. So once you get the information in a test or question so that you can identify them and then apply the rules correctly. Okay, so the first one is employer contribution to funds. Now those funds can be pension fund, provident funds, retirement annuity funds, medical aids. So whatever your employer contributes to those funds, they will be allowed to get that full amount as a deduction in their tax return when they calculate their taxable income. Then if a business pays annuities to its former employees or dependents of their former employees, they are allowed that deduction if the annuity is paid to an employee who retired due to old age, ill health, or infirmity. If they did not retire due to one of those, then they will not get that deduction. If it is a partner The additional requirement is that person had to be a partner for 5 or more years before you would be able to claim that deduction. And if annuity goes to an dependent or a former employee's dependent, so someone that passed away, they can also get the full deduction. Restraint of trade, this is where a company is not allowed or forces an employee to not be able to work in the industry they are busy working in, so then they have to pay over an amount to that employee for the period which the restraint of trade is for. Now, because of the fact that this is seen as capital in nature, this would not be allowed in terms of Section 11A. So that is why there's a specific deduction for this. Now, because we've actually incurred it on carrying on our trade, specifically if you look at natural person, labor brokers, personal service providers, this would be income in their hand. So they would be taxed on their side. So that's why a business is allowed to get the deduction. You will be allowed to get that deduction over the longer of the restraint of trade period or a 3-year period, whichever is the longer. So if the restraint of trade period is, for example, only 2 years, this amount would be calculated over 3 years and not 2. If the restraint of trade is, for example, 5 years, then we would use the 5 years instead of the 3 years. Okay, so that's just what you need to remember. Restraint of trade payment, the longer of 3 years, or the restraint of trade period. Whichever is the longer will you use for your deduction. Bad debts, this is when I sold something to a debtor, but now they are unable to pay me. So the amount that is due will no longer be paid. The person maybe went insolvent or they've disappeared. Then you are allowed to deduct it from your taxable income if you included that amount in income previously. Okay, so that means I was previously taxed on that amount, then I can get a deduction. However, if I recover a portion of that from an insurer, so let's say I took out an insurance policy for in the event that my debtors can't pay me, the insurance policy would cover that, then I will not get a deduction. But that also means whatever the insurance company pays out will not be taxed again. Okay. Doubtful debts. The new rules are you have to look if IFRS 9 has been applied. So IFRS 9 has not been applied. You apply 25% for everything 60 to 120 days old debtors, and everything over 120 days would be 40%. Now, in a question, if they don't specify the period, then you just apply the 25%. Okay. If you have applied IFRS 9, then you use 40% of the loss allowance lifetime expected credit losses plus the date written off for accounting purposes, and then you get an additional 25% allowance per IFRS 9. Now, normally in the test, they generally ask this one because of the fact that IFRS 9 is quite complex, and we just want to see if you understand the basic principles. Now, what you need to remember with this, you have to add back the allowance that you claimed in the prior year in your income in the current year. Now, the reason we do that is because the allowance you work out for the current year is based on the full outstanding amount. And SARS technically only gives you a deduction for the movement from one year to the next. So that is why we add back the allowance from the prior year in the income in the current year. You need to show the two separately because marks are allocated to these ones separately. And you will lose the marks if you combine them into one. Then other deductions relating to intellectual property. So here you have to look at what type of patent, copyright, design, or trademark it is. So if I'm registering, extending, or renewing any type of property, intellectual property, I deduct the actual cost for that year. If I am acquiring, so I am purchasing intellectual property, and this relates to everything except trademarks, I need to go look at what is the amount. If the amount is less than 5,000, I can deduct the full amount. If it is more than 5,000, then I have to go look at what type of intellectual property is it, because the percentages vary. So all you have to remember, everything is 5% except design is 10%. Okay, so patents and copyrights, 5%, design 10%. So I take the amount that I've actually incurred and I multiply it with that percentage to work out what is the deduction that I'm allowed to receive. Research and development, this is where a company is trying to develop new products or services. So here you have to look at whether it's a non-capital expenditure or capital expenditure. If it's non-capital expenditure, you get 150% deduction if all of the requirements at the bottom is met. So it must meet the definition of research and development. It is approved by the Minister of Science and it was conducted in South Africa. Now, in a question, if they give it to you, you can assume it meets the definition, but they need to specifically tell you that it is approved by the minister and the company is located in South Africa for the other two to be met. If not all of those are met, then it's only 100% that you can deduct. If it's a capital allowance, so let's say I purchased new and unused machinery, then I can get a capital allowance for that R&D expense for 50% in year 1, 30% in year 2, 20% in year 3. If it relates to a building, however, it's 5% over the 20 years. Okay, so just to remember, it's generally 150% if the requirements are met, otherwise 100% if it's a normal expense. If it relates to a capital asset, so new plant, new and unused, so not used, new and unused machinery and plant, it's 50-30-20 rule, or buildings is 5% over 20 years. Then legal expenditure. You can deduct any legal expenditure that you had to incur in order to defend your business, which is also related to the production of income. If you can't claim it in terms of Section 11C, generally it will also be allowed in terms of Section 11A as it was incurred in the production of income. However, if the expenditure is of a capital nature because it creates an enduring benefit, then you need to see if it falls under 11C, which is the specific one. Then donations to PBOs. Now, what is important to note here, this is based on the subtotal after all of the expenses have been deducted from your income amount and your taxable capital gain have been added on. Now, that deduction is limited to 10% of that subtotal. If the amount that you actually paid is less than the 10%, then you would claim the actual amount. If it is more than the 10%, your deduction is limited to the 10% that you've calculated. Okay, and any excess amounts are carried forward to the next tax year, so then you can get a deduction in the following tax year. Then prepaid expenses. This is amounts that you have paid for future expenses. Then you have to look at two things. So the first rule you look at, will that expense incur within the next 6 months? So if the expense that I've paid will actually happen within the next 6 months of the year end, I can deduct the full amount. Then I have to look at the remaining expenses. So whatever is left over of the prepaid expenses after deducting whatever relates to the 6 months, if all of those in total is less than 100,000, then I can deduct that as well. If it is more than 100,000, I can only deduct it in the following period, in the following tax period. Our prohibited deductions, this list you just need to study, is losses and expenses under an insurance contract will be prohibited as a deduction. Any taxes, penalties, or interest on tax will be prohibited. Any provisions, so that is something that is relating to a future expense and is not unconditional liable yet, those would not be allowed as a deduction. Any expenses to produce exempt income, non-trade expenditure, any restraint of trade payments, unless the requirements have been met. So it is due to ill health, they've already retired due to ill health, old age, or if those requirements are met, then you can deduct it. And then expenditure relating to employment. So that is if you're an employee, you cannot deduct, for example, your travel expenses to the work, from home to work, or expenditure to buy clothes for work, you will not be allowed to deduct it. And then fines and unlawful activities. So that is, for example, bribes that you pay will not be allowed to be deducted. Now, if we look at capital allowances, these are specific allowances that were excluded from your general deductions because of the fact that they are capital in nature. And that is generally writing off the asset's cost over specific periods of time. Okay, now what is important to note here is the cost includes any moving cost, installation or erection cost that is incurred, but it excludes VAT, especially if you are a registered VAT vendor. Then you have to remove the VAT amount when you do the calculation. If I purchase something secondhand, then there is the assumption that there is notional input VAT included in that amount that I need to remove. And if an amount cannot be quantified, you can only deduct it once you can determine the amount. Okay, now repairs and improvements, you need to distinguish between what will happen to the asset. Will the asset be returned to its former condition, or will it actually be improved? Will it be made better? Now, this relates to property used for trade, treatment against beetles such as property, machinery, implements, utensils, other articles used for trade. Now, what you have to look at is if it is an improvement or addition to a property, it will not be deductible in terms of the section because it would be viewed as capital. Now, how do you know if it's an improvement or if it's actually a repair? Improvements create a better asset. So let's take, for example, a printer. If a printer normally prints 100,000 copies until we have to replace it, and you then take it in to get repaired, and they repair it so that it can still do the 100,000. Then we've only repaired it. We have not increased the number of pages that it can print. If they now put in some additional equipment and now the printer can all of a sudden print 200,000 copies, then we've actually improved that printer from its original condition. Okay, so that is how you should think about it to determine whether something is an improvement or a repair. Okay, now section 12C relates to new or unused. Now this is very important, new or unused, because used they have a different percentage. So that's machinery you've brought into your business for the first time, and that includes the moving cost. Now for these ones, you are allowed to get a deduction of 40% in year 1, and then year 2, 3, and 4 is 20%. Whereas if it is a used plant or machinery, or it does not qualify for plant or machinery, so it's something else, then you would write it off over 5 years, which is 20%. So it's important that you know these rules. They generally tend to ask you 2 assets which falls into the different categories. So you need to be able to distinguish between the two. Okay, so what does the process of manufacture mean? That means I am creating something. I am making something using those machinery. That is what manufacture is. So creating something new or taking a raw material, creating a new product, that is what manufacturing is. Okay, wear and tear. This is for all your other assets that doesn't fall under section 12C. That is, for example, for office furniture, any laptops, any like chairs, desks, that would generally fall under section 11E. Now in your test, they will give you the list of the write-off periods. You don't need to study it. They have provided you with the list in the workbook just to go through when you do the questions, but in the test, in the exam, they will actually provide you with what period you need to write it off over. Okay, now what you have to do is you take the value of the asset and then we divide it over the expected lifetime. Now the expected lifetime is the useful life, so they can either give you the number of years or they can give you a percentage. So if it's number of years, you divide it by the number of years. If it's a percentage, you multiply it with the percentage. Okay, we generally take the market value of the asset if there's any connected parties, and it does not apply to buildings because buildings falls under section 13, which have their own rules. And this one specifically, okay, so section 12C, we do not apportion at all. You get the full deduction irrespective of when it was brought into your books. With wear and tear allowance, the section 11E, we have to apportion it similar to depreciation for the period that we've actually used it for. If an amount is less than 7,000, we are allowed to write off their full amount in that same year. Okay, so that is an additional exception to the general rule. For small businesses, section 12E says if I'm using an asset for manufacturing, so it's new and unused, I can deduct 100% of that asset in the year I brought it into use. If it is any other asset, I can deduct 50% in year 1, 30% in year 2, 20% in year 3, and if I get a better deduction in terms of section 11E, I can still use that one. I don't have to use the non-manufacturing one, but generally that non-manufacturing one is good for any assets that are for 3 or more years. The percentage would be better. How do you know if something is a small business corporation? They would specifically state it in the question so that you know you need to apply this section. Okay, if they do not specify that, then you will not apply the section. You would apply section 12C or 11E. Now, building allowances, generally for your buildings, it's 5% per annum, and it relates to new buildings purchased by the taxpayer in the process of manufacture. It, however, does exclude the cost of the land and any leasehold improvement amounts. Okay, so normally we take, for commercial buildings, section 13 Quin, we take 5%, which is over the lesser of the cost or the market value of the building. Now here you have to look at commercial buildings, whether we purchased it new or whether it's second-hand buildings that was improved by a developer, because you have to apply 55% to the purchase price if we purchased it new and then apply the 5%. Or if it's second-hand, I apply 30% and then only the 5%. So what they've done is, because of the fact that the building values are so significantly higher than they were in the past, they have brought in these additional percentages that needs to be applied to reduce the expense that is allowed. If you've got residential units, you have to go look at whether it is a low-cost unit or a normal residential unit. So if it's low-cost residential units, if it's a standalone unit, it must be less than 300,000. If it's an apartment, less than 350,000, and the rental amount needs to be less than or equal to 1% of the cost of that initial price that you paid. Then I can claim for a normal residential unit 5% over 20 years, or if it is a low-cost one, 10% over 10 years. So for low-cost residential units, you get a quicker write-off, and then similar, if you purchase it from a developer, if it's new, you have to apply 55%. If it was improved, so it's second-hand, you apply the 30%, similar to the other building allowances. If you've got urban development zones, if it's a refurbished building, it's 20% over 5 years. If it is a construction of a new building, it's 20% in year 1 and then 8% for the remaining 10 years that you write off. Okay, and similar, we have to apply the 55 of the 30% rule, And then if it's improvements to existing buildings, other buildings is 20% per 5 year, or low residential is 25% for 4 years. Section 11O, this is when I sell an asset and I'm actually making a loss on the sale of that asset. You are allowed to claim additional Section 11O scrapping allowance, okay? And that is generally for capital allowances were claimed in terms of Section 11E, 12C, or 12E, and the estimated useful life of that asset is less than 10 years. Then you determine on disposal what is the loss that you made and that you are allowed to deduct. So the loss we work out by taking the sales value less the tax value, which is your carrying amount of an asset at that stage, to work out what is the loss amount. And that is what you deduct. Okay, do you guys have any questions on the expenses and what we've discussed so far?